As introduction, APECS Holding BERHAD is a Malaysian diversified company with operation in plantation, real estate and property development and food manufacturing. The company operates through 3 divisions, each contributing to its overall performance but also facing different financial reporting issues. The 3 divisions are Plantation Division, Real Estate and Property Division and Food Manufacturing Division. Okay, beer plants like oil palm tree under MFRS 116 function as factories to produce agricultural goods over multiple periods and are recorded at cost. Conversely, biological assets such as fresh fruit bunches under MFRS 141 are managed for biological transformation. Okay, since these are intended for sale or production, they must be recorded at fair value to reflect their changing value as they transform. Okay, on your right side, faithful representation is compromised because the valuation lacks neutrality, being biased to attract investors. It lacks completeness by omitting risks like pest or weather and contains error by applying mature FFB prices to immature FFB. Okay, on your left side, while the form relies on market prices for harvested FFB, the economic substance is that these are immature assets still on the tree, facing significant biological transformation risks before they are harvestable.
A more faithful valuation approach will adjust the value of the immature FFB based on the actual stage of development and the risk involved. Instead of using the full market price of harvested FFB, the company should consider factors such as biological uncertainty, expected yields, cost to complete growth, and possible market fluctuation. This would produce a more realistic and reliable fair value estimate. As a junior accountant, complying with the CFO instruction creates ethical risk because it may lead to misleading financial statement and overstated profit. This could violate important professional principles such as integrity, objectivity, and professional competence. So, before raising concern, I should gather supporting evidence from MFRS 141 and the IASB conceptual framework. Then, I should discuss the issue internally with the CFO or higher management and document all communication carefully. If the issue is not resolved, I may need to escalate it to the audit committee or seek professional advice. Beyond my duty to the employer, I also have responsibility to external users, such as investor and auditor. Financial statement must provide truthful and reliable information so that user can make informed economic decisions.
For property 1, since these units are legally separable, MFRS 140 requires individual accounting, but 7 floors are investment property under MFRS 140 and 3 floors are property, plant and equipment under MFRS 116. Property 2 is entirely investment property under MFRS 140 as land held for undetermined use qualifies as capital appreciation. Property 3 is MFRS 102 inventory since it's treated as work in progress because we are actively building it for commercial sales.
For property 1, the lease floor, which are the 7 floors, they are measured at cost for the initial recognition, including the transaction cost. Then, the subsequent measurement, they will be measured using the fair value model or cost model, while the remaining 3 floors used for HQ, their initial recognition also measured at cost, while the subsequent measurement is set using cost model or revaluation. The second property, which is land, is recognized by cost, while the subsequent measurement is calculated using cost model or fair value model. Lastly, in the fourth zone is condominium. It is also measured at cost for the initial recognition, and the subsequent measurement is determined by the lower of cost and net realizable value. Okay, so the CFO of the APECS Holding BERHAD proposed an application of the MFRS 140 fair value model across all 3 properties solely to manufacture paper profits and artificially expand the group's asset base for an investor. This intentionally violates the qualitative characteristic of faithful representation under the IASB conceptual framework. So this is because, firstly, it is a failure to depict economic substance since faithful representation requires financial information to represent the true economic substance of transactions, not just their legal or preferred form. So secondly, it involves compromising neutrality. A faithful representation must be neutral, meaning it is without bias in the selection or presentation of financial information. So the CFO strategy is intentionally biased, driven by a desire to look favorable during strategic negotiations rather than providing an objective, balanced view of operations. So the last one is involves misleading external stakeholders by inflating earnings through unearned asset valuation or properties that fail the investment property definition. The company risks providing a non-neutral, unverifiable depiction of performance to potential strategic investor.
Let's move to the food manufacturing division. For the product recall, the company should recognize a provision of 1 million ringgit. This is because all three conditions under MFRS 137 are met. First, there is a present obligation because the company announced the product recall. Second, the outflow of economic benefits is probable as management estimates that 70% of the product will be returned. Third, the amount can be estimated reliably, with 1 million ringgit being the best estimate. For the consumer lawsuit, the company should not recognize a provision. This is because the lawyer believes there is only a 30% chance of losing the case, so the outflow is not probable. Therefore, the lawsuit should be disclosed as a contingent liability in the notes to the financial statement, not recognized as a provision.
Next, for provision question B under MFRS 137, uncertainty determine whether the liability is recognized as a provision or disclosed as contingent liability. If an outflow of economic benefits is probable and can reliably estimate, a provision is recognized, as in this case of the product recall cost. However, if the outflow is only possible but not probable, no provision is recognized and the item is disclosed as contingent liability, as with the consumer lawsuit. In conclusion, this case study highlights the importance of applying a correct accounting standard and maintaining ethical behavior in financial reporting. Accurate and faithful reporting help ensure transparency, protect investor interest, and strengthen public confidence in company financial statement.